Hello, very good morning good afternoon to all. Pardon me, very good afternoon to all. Welcome to today's daily dose of market insights. Kelvin here again. Very good afternoon. Today will be Thursday, the 6th of February 2025. So as usual, before we start the gist of our daily dose for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of the intraday performance on the key cross asset classes, relevant news flow, and as well as a key economic data release. All right, so let's start with the major US stock indices first yesterday for the intraday technical performance of what has taken shape yesterday. All right, so what you could see over here is that, pardon me, is the intraday performance of what has taken shape yesterday. So what you could see is that all the four major US stock indices ended in the green, and the Dow Jones continues to outperform together with the Russell 2000 up by 0.7% for the Dow Jones, the Russell 2000 up by 1.14%, outperformed the Nasdaq 100, which is only gained by 0.4%, very similar for the SPX 0.4% as well. So for those who follow my daily dose of market insights, on Monday, I shared with you all there's this intermarket dynamics that's taking shape in the US stock market, where we start to see the relative ratio between the Dow Jones and the Russell against the Nasdaq is now showing signs of medium-term outperformance, and it seems to be playing out right now. And the reason why all these four major indices closed in the green yesterday for the US stock market is due to what I call trade deal optimism again that is coming out from the market. So we know that this trade tension between US and China is still ongoing because number one, the US hit China with 10% trade tariffs. And initially, we thought that there was some deal that may take shape between US and China, but the deadlines already passed on 4th of February. Then on that similar day itself, China hit back with 10 to 15% trade tariffs on US products heading into China. So these products are more energy related and agriculture, and as well as China also limits certain export control of key resources materials into the US defense industry. All right, and as well as a kind of a launch into what I call antitrust investigation into one of the mega cap US stock, which is Google, i.e. Alphabet. And US yesterday retaliated by this UPS, the United Parcel Service, which is one of the key postal company in US that handle inbound China packages, especially pertaining to China e-commerce firm that are selling at a very relatively cheaper discount to US consumers. So this like more or less like Taobao, for example. So initially, United UPS, in short, in US Postal Service actually has this we call it ban to actually ban inbound shipment from China and Hong Kong. But however, the earlier suspension was reversed. Right, they reversed their decision at during the start of the US session yesterday. So that causes a bit of risk-on optimism into the US stock market. So that's what explains why the major stock US indices rallied yesterday, because of this kind of optimism, where market view this that potentially there could be some form of trade deal that could be there's some middle ground to be discussed before China give that deadline on the next Monday to impose that 10 to 15% tariffs on US energy and agriculture products heading into mainland. All right, so that's actually explained the optimism. And also, because of this optimism that has taken shape yesterday, the dollar actually weakened. So if you look at the US dollar against the major currency, so let me put it in writing over here. So this will be 6th of February as we are speaking right now. Okay, 6th of February. So what you could see over here is that this 5-day rolling performance of the US dollar against other major currency as of 6th of February we are speaking right now the dollar actually weakened further yesterday on this so-called potential trade deal, we call it negotiation or trade deal, potential trade optimism, or some form of middle ground that could be found between US and China before the Chinese trade tariffs deadline hit on next Monday, which is 10th of February. So yeah, we got to respect the price action of the intraday price action that has taken shape yesterday for on the FX market. And on top of this, over here is that what we could see is that gold continues to be rather resilient. So gold itself continues to form as a safe haven hedge in this ongoing fluid trade tension, not only between US and China, and potentially stretching up to other US trading partner as well. So for the gold market, market participant did actually sell off the gold, and gold rather remain firm and trade at a key fresh all-time high yesterday at the start of the US session, despite the fact that the UBS reversed its earlier, we call it China and Hong Kong inbound shipment to US. So something to actually take note of is that this potential risk-off scenario that could still be inherent in the market because it's still not being reflected in other cross-asset classes like gold. All right, and one of the other key facts I want to look at over here is more pertaining to the one of the leading economic indicator to gauge the health of the US economy is the ISM services PMI data. So for the ISM services PMI data yesterday, it came down below expectation. So market is expecting 54.3, slightly above 54 that was printed in the month of December. So for January, it came in 52.8. So if you look at the trend of the services PMI, it seems to us that after hitting a high on October at 55.8, it starts to plateau and starts to shape a pair of lower high. So what it means that it seems to us that services activities in US has starts to actually start in terms of growth trajectory. That means the growth has starts to slow down, which means, i.e., any potential signs or what I call that boomerang effect from ongoing US administration hawkish trade tariffs policy could potentially boomerang back to the US economy and cause the services, we call it activities, to actually deteriorate in the US. And bear in mind, all these are survey-based indicator. Okay, because anything that's regarding about PMI is all survey based. That means the organization just sent out a slew of survey based questionnaire to purchasing managers of the respective services industry in the US. That means, i.e., business sentiment has started to turn not so optimistic as compared to 3 to 4 months ago in the US economy. So something to take a look out for over here. But one thing for sure is that market participants still expecting the Fed to actually introduce 2 interest rate cut this year. Why? Because also being supported by the ISM services prices subcomponent. So this prices subcomponent is actually indirectly a survey on the cost of doing business for the services oriented company in the US. So this services prices subcomponent is still continuing to be rather high, but the rate of growth starts to temper off. Previously was 64.4, it actually dipped down slightly by 4 points to 60.4. So if you look at the trend of the services price subcomponent over here, let me run. Okay, give me a couple of seconds to run it. All right, so it should be out by now. All right, so if you look at the 5-year trend, right, it's still trending higher. There's still a series of higher high and higher low, but last month figure starts to dip slightly. So it's more like a bit of a minor slowdown in this cost of doing business in the services firm in the US economy, but the trend is also still generally trading upwards, trending upwards since the March 2025 swing low of 53.4. All right, that means, i.e., the expansion, the trajectory is still on the upside, except that yesterday it did a minor dip, and market actually rejoiced about that and causes the dollar strength to actually shape that extended setback in yesterday's intraday session. That means the trajectory for the US CME Fed Watch 2 as based on the Fed Funds futures market pricing still remains unchanged. So market participants are still looking at potentially 2 interest rate cut before 2025 ends. So that is almost the same as what has taken shape last week after ex-post FOMC meeting. So for 19th of March, market participants still assigning a high probability of 83% or 84% if you're speaking right now for the Fed to maintain steady the Fed funds rate at 4.25% to 4.5%. And if you look at the aggregated cap, where actually it shows the expectation down the road based on the latest relevant data that has been we call it exposed to the market participants right now, taking into account of what the latest data of the ISM services PMI shows, market is still looking for the next rate cut to come in potentially only in June, 18th of June FOMC meeting, right? At 25 basis point cut, or July, because they have a high odds of 87% and 8%. And the next potential rate cut will be either in October, 29th of October or 10th of December 2025 FOMC meeting with a high odds of 62%. The higher one will be in the 10th of December FOMC meeting, which is at 86%. So net overall, the pendulum of expectation still remains the same based on the latest ISM services PMI data and the services prices input subcomponent data. So market is still looking at two potential interest rate cut before 2025 ends, but we know that things could be fluid. Anything that is if the potential we call it trade tariffs or trade war starts to move up by the higher note, there's more tick for tat measures between the relevant parties, then this potential we call it interest rate cut may be lesser, because given the fact that more more tick for tat measures is higher inflationary in nature. Okay, so this is the situation over here, and I want to also share with you all the intraday performance of the various the component stock of the S&P 500. So what we could see over here is that there are more greens than red, but what we could see is the mixed bag within the mega cap technology space, where we start to see a bit of bargain hunting in Nvidia, the chip sector, after that kind of sell off or underperformance in the last 3 to 4 sessions or so. All right, so Nvidia gained by 5.21%, and almost all the chip sector is chip stocks within the semiconductor sub industry within the information technology sector is in the green, except for AMD due to its lackluster performance. Lackluster, I don't want to say, due to its one of the product segment, which is data center, miss expectation. Very similar for Google as well. So Google, one of its product segment miss expectation and caused Google stocks to plummet by negative 7%, and also the potential ongoing antitrust violation investigation by China on towards Alphabet and Google in the ongoing trade tension that is taking shape between US and China, and it start to spread out to Amazon as well, and as well as Tesla, which is both of them down negative 2.4% and negative 3.6%. All right, so rather I say a mixed bag performance among the mega cap stocks, but since there are more greens than red, that's why the S&P 500 managed to close in the green, but underperform the Dow Jones and the Russell 2000 due to this mixed performance in its mega cap stocks that has a higher weightage on the intraday performance of the S&P 500 and the Nasdaq 100. All right. So this and one more news flow I share with you. Okay, is Fed baking. So Fed baking over here is that he rather give a neutral kind of guidance, saying that spending and growth data has been pretty favorable. He's mentioned that current interest rate is still moderately restrictive. So it's more of a balanced approach over here, saying that yes, the US economy is still rather robust, but however, interest rate is still kind of restrictive. That means i.e. still supporting a chance of at least one interest rate cut before 2025 ends for the Fed, by the Fed. All right, so this is the key data news flow, and as well as the various intraday cross asset performance that has taken shape yesterday. All right, so right now let me share with you all the intraday technical outlook on the various broad-based cross asset classes. So let me expand my screen so that you guys could actually see the charts. All right, so let us start with the euro dollar. So yesterday euro dollar, we do have a bullish bias because of the price action breaking above the 20-day moving average and hit our set resistance as expected. at 1.044/1.0460 before tracing downwards. So what we could see over here is that the RSI also hit the overbought level before that pullback that has taken shape in today's Asia session. All right, RSI hit the overbought level as well, but however, they didn't shape a bearish divergence. Pardon me, they did not shape a bearish divergence. So i.e. what I could see over here is that means this reaction of the 1.440/1.0460 may not lead into a much more substantial potential bearish reversal to revisit at least the lower half or the 61.8% Fibo retracement at 1.0270. So what I could do over here is that potentially you may see a retest during the start of the European session at the 20-day moving average that has just been taken out 2 days ago over here. So this will be my first support level to watch for today at 1.0365. Then I'll use a slightly lower level. This is a very clear graphical congestion area. A nice reaction of it on the 15th of Jan, broke out, turns into a pullback support on 21st of Jan. Then after breakdown, turns into a pullback resistance again on the 4th of February, and now potentially may starts to see a pullback support rule taking shape. So this will be 1.0345. So I'll be using 1.0345 as my short-term pivotal support for today. Still maintain that intraday bullish bias on the euro dollar for the extension of this mean reversion rebound that has taken shape since the start of Monday Asia session low. First resistance zone got to watch out for will be the same as yesterday, 1.0440/1.0460. Above it potentially exposes 1.0530 intermediate near-term resistance level, which is the high of 27th of January. So let's say what we will do over here is if it starts to have an hourly close below 1.0345, then we will invalidate today's intraday bullish bias to see it taking in the form of a much more bearish footing for the euro dollar, exposing the next near-term support level at 1.0270. If 1.0270 does not hold, potentially it may revisit the medium-term pivotal swing support low at 1.02/1.0190 for the euro dollar. So i.e. using 1.0345 as my short-term pivotal support level to maintain that intraday bullish bias for this potential ongoing minor mean reversion rebound scenario that has taken shape since Asia session this Monday low. Okay, now flipping our attention now will be the sterling dollar. So the sterling dollar yesterday we do have a neutrality stance, and what you could see over here is that it starts to actually broke out above the 50-day moving average, and now it's trying to reintegrate back below it again. And the RSI still showing some room of minor pullback scenario on the price action because it has now dipped below the 50 level mark, and still has a bit of room before heading towards the oversold region over here. So net overall, two support level to watch as we head into the opening session of the European session today, 1.2450 followed by 1.2375. So as long as this potential dip down didn't surpass below 1.2375, which will correspond to the 20-day moving average as well. This will be my pivotal support level for today. Short-term pivotal support 1.2375. We will flip to a intraday bullish bias on the sterling dollar, looking at the next intermediate resistance zone at 1.2580/1.2610, which is the minor swing high area of 7th of Jan and 30th of December last year. Above it, potentially may see the next intermediate resistance level coming in at 1.2670, which is also the one-time Fibo extension taken from the low of 13th of January, and as well as the minor congestion graphical area of 17th of December and 19th of December. Only an hourly close below 1.2375. A breakdown below it will invalidate today's intraday bullish bias to potentially allow the bears to gain a better footing, exposing the next near-term support level at 1.2240 followed by 1.2150 next. So i.e. I'll be using 1.2375. Potentially there could be some sign of a minor pullback. As long as this minor pullback didn't surpass 1.2375, we will flip to an intraday bullish bias based on the current technical elements that I share with you guys for a potential extension of this ongoing mean reversion rebound scenario that has taken shape since Asia session this Monday swing low. All right, so that's for the sterling dollar. Now with that, let us focus now on the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar did a bit of whipsaw with our pivotal resistance yesterday, but it has that bearish reaction of this short 50-day moving average, and as well as the former descending minor ascending support or minor ascending trendline support now turns into a pullback resistance level, which confluence very closely with the downward sloping 50-day moving average as well. So this will be a level to watch. 62.95 are my first resistance level. So potentially there could be some form of a minor pullback or pullback taking shape for today. So let me do some adjustment. Okay, so this will be 62.25. Okay, so two near-term support level to watch: 62.25 followed by 61.65. So i.e. I'll be using 63.30, so that is my medium-term pivotal resistance level, since it's coming very close to it already. So we do not want to have that bullish bias, because it's almost about what 70 pips more before hitting 63.30. So I'll be using 63.30 as my medium-term pivotal resistance level. We will still maintain that bearish bias on the Aussie dollar, except that we do have higher levels of support level for today. 62.25, only a breakdown below 62.25, which is the 20-day moving average, also acting as a near-term support level, coinciding with this graphical key support area at 62.25. Below it exposes 61.65 next. Okay, so that's for the Aussie dollar. However, an hourly close above 63.30 potentially may visit the 64 figure level. Okay, let me put it in writing. .64 figure level. Okay, so this 64 figure level graphically is also the former major we call it range support, now turns into a pullback resistance. So this is a former major range support from the low of 13th of October, now turns into a pullback resistance at 64 figure, and also the former minor swing low of 19th of April, 1st of August last year at 18th of April, now turns into a pullback resistance as well, all confluencing at the 64 figure level. All right, so i.e. net I'll be using 63.30 medium term pivotal resistance level, still maintaining that potential intraday bearish bias on the Aussie dollar for today. All right, so with that, now let us now take a look at the dollar yen. So the dollar yen, yesterday we do have a bearish bias. The bearish bias hit exactly at our support level 51.90, and this 51.90 is also the lower limit of this minor descending channel that is in place since the high of 10th of January, and as well as a Fibo extension level of 0.764. And what's interesting over here is that upon hitting the support level, the hourly RSI is oversold with a bullish divergence as well. All right, with my price action shape a lower low, but RSI have a higher low right at the oversold region. So this is a bullish divergence. What it means that the downside momentum, the short-term downside momentum has potentially eased off. So with that, I'll be using 51.90 short-term pivotal support level, flip to a intraday bullish bias for today for a potential minor mean reversion rebound scenario to take shape, given the potential easing of this ongoing short-term downside momentum as being depicted by the bullish divergence at its oversold region by the hourly RSI. First resistance zone to watch will be the 200-day moving average, and this graphical level here 153.25, so it'll be 152.90 / 153.25. Let me put it in writing. Okay, 152.90 / 153.25. All right, so above 153.25 potentially sees the next intermediate resistance coming in for the extension of the mean reversion rebound, testing the next level at 154.10, which is formerly the minor swing low area of 13th of January, 4th of February. And if you will do the Fibo retracement of that last sell off from 4th of February swing high all the way down to today's Asia session low, that's correspond to the golden ratio as well as 61.8%. All right. However, if price action starts to push down and have an hourly close below 15190 short-term pivotal support level, then today's bullish bias for that potential minor mean reversion rebound scenario will be invalidated to see the continuation of this impulsive downward sequence, exposing the next near-term support zone at 1590/70, 14970/50 next, which is this graphical congestion area over here from 5th of December all the way to 6th of December last year, and as well as FIBO extension level of 1 time and 1.236 time. All right, so i.e. in a nutshell, due to this bullish divergence that has been fleshed out on the hourly RSI, price action may start to shape a mean reversion rebound on the minor scale, hence using 15190 short-term pivotal support level on the dollar yen, and we will flip to a intraday bullish bias for today. And that sum up the intraday technical outlook on a major dollar pair. And one particular interesting cross pair I want to share with you for today on a very short-term intraday technical outlook basis will be the Euro Sterling. So the Euro Sterling continues to remain weak on a short-term basis as price action continues to trend lower below the 50-day and below the 20-day, and as well as below the 200-day moving average. So today will be also a key risk event day pertaining to the sterling crosses. Why? Because later we do have a Bank of England monetary policy decision. Later I'll share with you all what will be the time that the monetary policy decision will be released, and coupled with the time where Bank of England governor will actually produce his actually usual speech right after the Bank of England monetary policy decision. But on a technical basis, the Euro Sterling seems to be exhibiting near-term potential technical weakness. So I'll be using 83.55, the gap down resistance level, as my short-term pivotal resistance level. Potentially bullish bias for today. Next near-term support level to watch will be 82.80, followed by 82.65, then thereafter followed by 82.30, which is the minor swing low of 19th of December. Only a push out and an hourly close above 83.55 will invalidate today's intraday bearish bias on the Euro Sterling to potentially see a squeeze up for a potential mean reversion rebound to retest the 20-day moving average, acting as a near-term resistance, next near-term resistance level at 83.90. Above it sees 84.20, which is also correspond to the 200-day moving average, acting as the next intermediate resistance level. All right, so that's for the Euro Sterling. Currently, at this moment in time, it seems to us that the current technical element seems to be exhibiting potential short-term technical weakness, as long as 83.55 short-term pivotal resistance is not surpassed to the upside. All right, so with that, now let us now turn our focus to the major stock indices, starting with the Asia Pacific one, the Hong Kong 33. So no change for the Hong Kong 33 as it continues to actually hold our first support level that we highlighted yesterday, 20,470, with the short-term pivotal support still remains at 20,160, at it can't break above the previous minor swing high of this Tuesday at 20,980. So since that it can't break above 20,980, I don't want to be so aggressive by tightening the short-term pivotal support to 20,470. So still no change, still remains bullish bias short-term for the Hong Kong 33 using 20,170 as my short-term pivotal support level. First resistance level, it got to surpass 20,980. Above it potentially exposes 21,320/21,390, which is the upper limit of this minor ascending channel from the low of 13th of Jan. One-time FIBO extension from the low of 13th of Jan as well, and the graphical minor swing high area of 7th of November last year and 9th of December last year that got rejected. Only a push down and an hourly close below 20,170 will invalidate today's intraday bullish bias to see a much more pronounced minor corrective decline scenario, revisiting the 20-day and the 50-day moving average, acting very closely as the next near-term support level at 19,685. A breakdown below 19,685 may potentially see a further slide towards 19,340. So once this 19,340 will be this graphical area here of 9th of January and 16th of January. And if you do the FIBO retracement of this ongoing push up from the low of 30th of Jan all the way up to the high of 4th of February, that also correspond to the 76.4 FIBO retracement pretty closely. All right, so i.e. in a nutshell, still maintaining that intraday bullish bias on the Hong Kong 33, 20,170 short-term pivotal resist, 20,170 short-term pivotal support level. First near-term resistance that it got to surpass will be 20,980. All right, so that's for the Hong Kong 33. Flipping our attention will be the Nikkei 225, i.e. the Japan 225, and it continues to actually trade sideways between the 200-day moving average and the 20-day and the 50-day moving average, acting as a near-term resistance level, which is also our short-term pivotal resistance that we have yesterday at 39,310. So yesterday it tried to push up, got rejected, and right now it's trying to actually push up towards this level again, the 20-day and the 50-day moving average. So using 39,001, okay, pardon me, using 39,310 as my short-term pivotal resistance level, still maintaining that intraday bullish bias on the Japan 225, but I have a higher first support level to watch for today, will be this 200-day moving average here that survived in yesterday's during yesterday's session, which is 38,680. 8,680. Okay, so using 39,310 as my short-term pivotal resistance level, still maintaining that intraday bearish bias within this minor sideways range configuration that is unfolding on the Japan 225. First near-term support level to watch, 38,680, correspond to the 200-day moving average as well. A breakdown below it potentially may revisit this Monday morning Asia session swing low at 38,410. Only an hourly close and a breakout above 39,310 potentially see a squeeze up towards the upper limit of this medium-term sideways range configuration that is in place since late September last year. Next resistance zone to watch after 39,310, 39,710 slash 39,830. Above it potentially sees 40,360 next. 40,360 next, pardon me. So that's for the Japan 225. Flipping our attention will be the German 30. The German 30 continues its bullish bias. We got to respect it. Well, yesterday we do have a bearish bias, looking for it to revisit the 21,100 level, which is the rising 20-day moving average. Unfortunately, this price action didn't actually continue, and it managed to bounce up and broke above the short-term pivotal resistance that we have yesterday at 21,520, and also surpassed this Monday gap down as well over here. All right, so with that, we got to respect the ongoing price action. The German 30 seems to be resuming its impulsive up move sequence within its medium-term uptrend phase. So I'll be using yesterday's European session low, 21,390 as my short-term pivotal support level. First support level to watch will be 21,520, but I don't want to put it so tight just in case of any whipsaw. So using a slightly lower level, which was yesterday's European session low, and as well as Tuesday's European session low as well that got survived in yesterday's minor push down. So 21,390 short-term pivotal support level, flip to a intraday bullish bias for the German 30. First resistance level to watch will be the current all-time high area at 21,820. Above it sees the next resistance coming in, which is being defined by a Fibo extension level at 21,960, followed by 21,990. Only a push down with an hourly close below 21,390 level, 21,390 level. Invalidate today's intraday bullish bias to see another round of minor corrective pullback unfolding. For sure, revisiting the 21,100 level, which is the 20-day moving average. Below it exposes 20,940 next. All right, so with that, net overall will be given yesterday's positive price action, we will be flipping to an intraday bullish bias on the German 30 using 21,390 as my short-term pivotal support level. All right, now turning our focus now towards the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 yesterday we were neutral between the upper limit at 44,670. So it actually broke above the upper neutrality limit, and we got to respect this positive price action on the US Wall Street 30 over here. So with that, potentially right now is actually may see a minor pullback. So this minor pullback, first support level to watch out for will be at 44,670. So but I don't want to put it so tight for 44,670 as my short-term pivotal support. I'll use it slightly lower to almost the low, the minor swing low area of yesterday. Yesterday US session, and as well as Tuesday European session at 44,250. And so this 44,250 also correspond very closely to the lower limit of this ongoing minor ascending channel since the low of 13th of January. So as long as this minor pullback didn't surpass below 44,240 level, we will flip to an intraday bullish bias on the US Wall Street 30 above 45,090/100, which is the current all-time high area over here, may potentially seize the next resistance coming in at 45,500/45,700 next, which is being defined by a previous Fibo extension level as well. So however, if price action starts to push down and break below the 44,250 level, today's intraday bullish bias will be invalidated to kickstart another round of minor corrective decline sequence to revisit the 20 and the 50-day moving average, acting as confluencing with this graphical support area here at 43,730/43,600. Only a breakdown below 43,600 may see a much more deeper minor corrective pullback to expose the next near-term support level at 43,095. Okay, so that's for the US Wall Street 30, flipping to an intraday bullish bias with two near support level to watch at hand, 44,670, with the then thereafter slightly below it will be 44,250 short-term pivotal support to maintain that intraday bullish bias for today on the US Wall Street 30. Now, turning our attention will be the Nasdaq 100. So the Nasdaq 100 also broke above the pivotal resistance yesterday that we have at 21,610. So yesterday we are looking for a bearish bias. That bearish bias didn't take hold, and price action continues to pierce up higher. All right, over here. So with that in mind, right now it's coming very high to that former minor swing high area of 31st of January, and as well as the swing high area of 22nd of January and 24th of January. So, and as well as this particular pullback line here, which is the former minor ascending trend line, now turns into a pullback resistance level as well. So with that, a bit of mixed element. So we will be flipping to a neutrality stance for today, a neutral stance for today. So neutral between this level here. Okay, let me push it higher. Okay, so neutral between 21,845/21,945. Lower limit of the neutrality level will be very close to the minor ascending trend line from the low of 3rd of February, now acting as the next near-term support level at 21,570 level. All right. Okay, 21,570 level. Okay, so 21, so neutral between 21,845/945, and the lower limit of the neutrality zone will be at 21,570. All right, unless we have an hourly close below 21,570, then potentially the intraday bearish bias will start to take shape again. So it seems to us that the Nasdaq 100 may start to be trapped in this kind of very complex sideways range configuration since it's high on 23rd of January. So with an hourly close below 21,570, potentially the intraday bears may gain a foothold within this sideways range, minor sideways range configuration, with the next support level to watch after 21,570 will be the minor swing low area of yesterday's European session low at 21,340 next. Okay, 21,340. Okay, above 21,945 will potentially seize a push up to revisit the current all-time high area at 22,135, which was actually being printed on the 17th of December. So i.e. We'll flip to a neutrality stance for today, neutral between 21,845/945. Upper limit, lower limit will be 21,570 on the Nasdaq 100. Okay, so with that, let us now focus our attention to the commodities market. So the coin market, let us look at gold. So gold yesterday rallied as expected and hit our resistance level at 28,830/28,890 before shaping that minor congestion or pullback over here. So now the RSI has already start to exit from the overbought level, and still there could be a risk of a pullback taking shape over here. So first pullback to take a look out for will be the former upper limit of this minor ascending channel, now turns into a pullback support at 2845. No change on the pivotal support level, but I don't put it so tight at 28,845. Still use 28,830 as my short-term pivotal support level. And if you do the Fibo retracement of this last significant push-up on the intraday basis from 3rd of February, minor swing low of Monday all the way up to yesterday's all-time high area, that actually coincide with the, okay, let me put it in so that you guys could see labels. Okay, right. Okay, so that actually coincides with the 50% Fibo retracement. All right, so with that 830 short-term pivotal support remains, still maintain that intraday bullish bias on Gold XAU/USD above 28,890, potentially sees the next resistance coming in on a near-term basis, 2,909/2,912, which is a Fibo extension cluster level. However, if price action starts have an hourly close below 2,830, today intraday bullish bias will be invalidated to open up scope for a potential minor corrective pullback sequence within its short and medium-term uptrend phase, as price action going to trade above the 20 and the 50-day moving average. Next support level to watch for this potential minor mean reversion decline scenario will be at 2,812, followed by 2,795, i.e. Still using 2,830 short-term pivotal support level to maintain the intraday bullish bias on Gold XAU/USD. So lastly will be the West Texas crude oil over here. So for the West Texas crude oil, yesterday we do have a bearish bias. So the bearish bias almost hit our support level at 71.05, and very clearly is now surpassed below the 50-day moving average as well. So for today, I'll be using a tighter key short-term pivotal resistance level, which is very close to the 50-day moving average, 72.70. So as long as 72.70 is not 72.70 short-term pivotal resistance is not surpassed to the upside, we will still maintain that intraday bearish bias on West Texas crude oil below 71.05, exposes the next near-term support level at 69.80, which correspond to the lower limit of this ongoing minor descending channel from the minor swing high of 16th of January, and as well as the minor swing low area of 20th of December last year and 24th of December, as well as the minor swing low area of 27th of December last year, which is at 69.80 as well. However, if price action starts to shape a push up and an hourly close above 72.70 short-term pivotal resistance, which is the tighter one for today, today's intraday bearish bias on the West Texas crude oil will be invalidated to potentially see a mean reversion rebound to revisit 74.15, which is the upper limit of this minor ascending channel, I think, as a next near-term resistance level. Above it, potentially see a further squeeze up to revisit 72.75/76.16, which correspond to the 20-day moving average as well, I think, as the next near-term resistance level. So i.e. Still maintaining that intraday bearish bias on West Texas crude oil using a tightened key short-term pivotal resistance for today at 72.70. All right, so that's also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data points to look out for, the key economic data to look out for today? So today, either the BOE over here, during the European session, there is not much not much interest to look out for, except for the Bank of England decision will be out at 8 p.m. Singapore time today. So market is expecting almost a 25 almost fully pricing of a 25 basis point cut based on the interest rate swap market to bring it down to 4.5%. So market will be hearing the statement, and as well as later on during the 2.5 hours later at 10:15 p.m. Bank of England Governor Bentley's speech to offer further guidance on the state of the monetary policy affairs in UK. So that could potentially impact the sterling dollar and as well as the sterling crosses. And in the US session over here will be rather quiet. So what we have in the US session, we do have a tier 2 job data, which is the initial weekly jobless claim data, out at 9:30 p.m. Singapore time. All right, then thereafter during the Asia session, we do have two officials speaking right at early Asia session tomorrow, 3:30 a.m. and 4:30 a.m. Fed Waller and Fed Daly, they'll be speaking. All right, and during the start of Asia session at 7:30 a.m., we do have Japan household spending. So if household spending continues to improve, that could potentially allow Bank of Japan to maintain its normalization interest rate policy by gradually increasing the short-term policy rate. And still recall that last month they hiked, and right now market is looking at a potential hike coming out next in the next 2 to 3 meetings. So to further solidify, there's this view of a potential BOJ hike in the coming next 2 to 3 monetary policy meeting will be how well household spending hold. That will be released on 7:30 a.m. Singapore time tomorrow. All right. So with that, that sums up today's daily dose of market insights. Kelvin here, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.